In Asean, millions of people skipped traditional banks and went straight to digital wallets. Today, digital banks are rewriting the rules of finance in this region. And what happens when 660 million people bet their money on a system still being tested? The story of banking in Southeast Asia goes back long before ASEAN was created, beginning in the colonial era. In the 19th century, European banks, mainly from Britain, the Netherlands, France, and Germany, set up branches across the region to finance trade, plantations, and resource extraction. Some of the region's oldest banks were founded during this time. The Bank of the Philippine Islands in 1851, the first bank in Southeast Asia, and the Bank of Java in 1828, which later became Bank Indonesia in 1953. At first, foreign banks dominated, but after global financial shocks, local and Chinese banks started to grow their presence, especially after World War I. After independence in the mid-20th century, most countries in Southeast Asia focused on building state-led financial systems to support economic growth. Central banks were created to control money supply and guide national development. The Asian Development Bank, ADB, founded in 1966, was an important milestone, supporting projects in agriculture and rural development, and later responding to oil price shocks in the 1970s. Still, during this period, banking remained mostly national and separate, with little regional cooperation. The Asian financial crisis of 1997 was a turning point. It exposed weaknesses such as weak currencies, overextended banks, and poor transparency, which forced governments to reform their systems. In response, ASEAN countries worked closer together, leading to the ASEAN Banking Integration Framework, 2014, and the launch of qualified ASEAN banks, like Maybank and CIMB, to operate more freely across borders. Islamic banking also gained momentum in Indonesia and Malaysia as a trusted alternative. In the 2010s and 2020s, digital banks and fintech companies entered the scene, marking a new era where Southeast Asia became not only a follower of global banking trends, but also a testbed for financial innovation. The numbers tell us one side of the story. Across Southeast Asia, digital banking licenses have been rolled out at different speeds. Singapore issued 4 digital bank licenses in 2020, split between retail-focused and wholesale banks. Malaysia followed with 5 licenses in 2022, including GX Bank by Grab and Boost Bank by Axiata RHB. In the Philippines, the central bank approved 6 digital banks such as Maya, Tonic, and GoTime. Indonesia has no separate digital bank license, but OJK regulations allow banks like Jago, Cbank, and Alo Bank to operate fully online. Thailand is in the process of awarding its first virtual bank licenses by 2025, while Vietnam is testing digital banking through pilot sandboxes. Beyond banks, national QR systems like QRIS in Indonesia, PromptPay in Thailand, Do It Now in Malaysia, and Bakong in Cambodia have brought millions of new users into the digital financial ecosystem. But the reality is more complex. Only a few players have reached profitability. In the Philippines, Maya reported its first positive earnings in 2024, while others like GX Bank in Malaysia are still burning capital to acquire customers. Consumer trust is another hurdle. Many people still see traditional banks as safer, especially for savings and loans. Regulations also vary widely. Singapore and Malaysia enforce strict licensing and capital requirements, while Indonesia and Vietnam apply more flexible rules to encourage innovation. This mix creates opportunities, but also means digital banks must prove they can balance growth with compliance, trust, and sustainable economics. The growth potential for digital banks and fintech in ASEAN is massive. With over 660 million people, many of whom are underbanked or unbanked, the region is a natural testbed for new financial services. Key opportunities include SME lending, where small businesses often struggle to get credit from traditional banks, cross-border remittance and trade finance, especially in economies like the Philippines and Vietnam with large migrant worker populations, and micro-investment and digital insurance, which allow younger consumers to start small but build financial habits over time. These segments represent billions of dollars in untapped demand, ready to be unlocked by technology and smart regulation. The momentum is being reinforced by regional initiatives. Asean payment connectivity has already linked QR codes and instant payment systems across Indonesia, Malaysia, Thailand, and Singapore, making cross-border transactions easier and cheaper. Looking ahead, Project Nexus, led by the Bank for International Settlements and regional central banks, aims to connect multiple real-time payment systems by 2026, creating a seamless network across Asia and beyond. If executed well, this will accelerate digital trade, boost consumer adoption, and position ASEAN not just as a fast-growing financial market, but as a global leader in payment innovation. Despite the strong growth story, digital banks and fintechs in ASEAN face serious challenges. The economics of the business remain thin, with high customer acquisition costs and declining global fintech funding, putting pressure on profitability. Many players are still reliant on investor capital to scale, while only a handful have shown sustainable earnings. Regulatory fragmentation adds another layer of complexity. Some countries, like Singapore and Malaysia, apply strict licensing and capital requirements, while others, such as Indonesia and Vietnam, use sandbox models that are more flexible but create uncertainty when scaling across borders. Technology and security risks also loom large. Fraud detection, reliable KYC, know your customer processes, and strong cross-border AML, anti-money laundering frameworks are essential as payment systems become more interconnected. At the same time, competition is intensifying. Incumbent banks are digitizing quickly, neobanks are trying to capture underserved markets, and big tech players like Grab, Sea, and GoTo bring ecosystems with millions of users into the financial space. This crowded playing field means that only digital banks with strong unit economics, regulatory trust, and secure platforms will survive in the long run. Southeast Asia is no longer a quiet corner of the global economy. It is a proving ground where the future of finance is being built in real time. In a region of 660 million people, millions skipped the branch and checkbook era and went straight to digital wallets, QR codes, and instant payments. From Singapore's digital banks to Indonesia's QRIS, from Maya in the Philippines to GX Bank in Malaysia, this is where innovation collides with scale. For the world, the message is simple. If you want to see what banking looks like tomorrow, look at ASEAN today. This is not just about apps, it's about reshaping finance for 660 million people. Will ASEAN's digital banks become profitable giants, or remain fintech experiments? Subscribe to ASEAN Finance Insider for more deep dives into the deals, the data, and the dynamics shaping this future market.